Dear learner, welcome. This is our second lecture on financial management. This is unit 14 in block 4 of your TS3 course. In our first lecture, we have discussed the basics, that is what is finance, what are various financial functions, and what is financial planning. Now in this lecture, we will discuss about the capital. We will discuss a little bit in detail about various sources of funds. Then we will discuss about working capital, what is the meaning of working capital, what are various types of working capital. Then we will also discuss about the cash, the various motives of cash, and we will understand the cash management. So first of all, we will discuss about the meaning of the capital, or how to raise the funds for the business. See, the funds, they are necessary for business, not only for the establishment of the business, but also for the day-to-day operations of the business. Let us take an example. You have a capital of 10,000 rupees and you started some venture and you made your first product. You invested your 10,000 of the capital in production of a particular product. Then you have a buyer who wants to purchase your product for 13,000 rupees, and there is a condition that he will pay the amount after 1 month. Since he is your first buyer, you sold your product to him. Now let us analyze this situation. You produced, or you made a product at the cost of rupees 10,000. You sold it at the cost at 13,000. So effectively you have a profit of 3,000 rupees. But since the payment will be coming to you after 1 month, at the moment you do not have any cash to make further product or to further operate your business. So that is the thing that we are going to discuss, and how to avoid such kind of things in business, or how to manage the working capital, or what are the requirements of cash in this particular lecture. So as we have spoken, funds are required not only for establishing the business, but also for the operational requirements of the business. Now, how to raise the funds? Funds can be generated internally as well as externally, from long-term as well as short-term sources of funds. What are the internal sources of funds? That is the owner's capital, retained earnings of the business, sale of stock, sale of fixed assets, effective utilization of working capital, debt collection. These are some of the internal sources of funds. What are the external sources of funds? Debt and equity. These are the external sources of funds. Now the external sources of funds, they can be again of two types. One is the short-term sources, one is the long-term sources. So what is the meaning of this short-term here? Means the funds whose repayment is due within 1 year. They are termed as the short-term sources. In the short-term sources, we have overdraft agreement, borrowing or deposits from the friends and relatives and others, spontaneous capital through capital from vendors, short-term loans from banks, NBFCs payable within the 1 year. Because in the short-term sources of funds, we have defined that short-term is the funds which are payable within 1 year. So there can be an overdraft agreement with the bank. We can have the borrowing or deposits from friends or relatives or some other persons. There can be spontaneous capital through capital from vendors. Then there can be short-term loans, etc. These all are the short-term sources of funds. Then there are long-term sources of funds. In long-term sources of funds, there can be term loan from banks and other financial institutions, issuance of shares and bonds. These are all long-term sources of funds, means their repayment is due not in 1 year but in a longer span of time. So we have seen that for the business operations we need funds, not only to establish the business but also for the day-to-day operations. The funds can be raised internally by the way of owner's capital, retained earning, sale of stock, etc., or they can be raised externally through short-term as well as long-term sources of funds. Now, how to decide the source of funds? In case of external funds, or external generation of funds or external raising the funds, how to decide the source, whether we need to raise the funds from short-term sources or we need to raise the funds from long-term sources. So we generally use the short-term sources when we need to meet any temporary shortfall in funds, and these funds are typically repayable in any year. The negative point is the limited amount of funds can be raised from short-term sources. See, there is a temporary shortfall in funds. Like you are operating a travel agency and there is a very good booking. For that you need to block the hotel rooms and you need to block the airline tickets, but you do not have the funds, and the client will make the payment within next 1 month and then you can repay the funds. So this is basically the short-term or temporary shortfall of the funds. So here we will use the short-term sources of funds. We will borrow some funds from our friends and relatives, or we can take overdraft from the bank, or we can ask the vendors for the spontaneous capital. So whenever there is a temporary shortfall of funds, we use the short-term sources. The limitation is that we cannot raise huge amount of funds. Only limited amount of funds can be raised from these short-term sources. Suppose you want to open new offices of your travel agency, you want to set up a new marketing division, or you want to scale up your marketing campaign, or you want to purchase some new machinery, or you want to purchase some new cars. Now these are all the expansion or scaling of operations. So here we require the long-term sources. So long-term sources are to be used in case of scaling up of operations, when we need to scale up the operations and we need to expand the business. The negative aspect of these sources is they get linked with the ownership of the company or debt. Means the long-term sources are basically of two types. One is debt and one is equity. Equity is basically when you are sharing the ownership of the company by way of issuing equity shares, or it can be a term loan, like we can take a long-term loan from the bank, or it can be a mix of both, like we can raise the long-term funds by issuing equity shares as well as taking a long-term loan or term loan from the bank. Now again, this is the one of the financial decisions that the financial managers need to take, that how much of the sources to be raised by the way of debt and how much of the funds that need to be raised by way of equity shares. So in case of long-term sources we can get larger amounts. In case of short-term sources, the limitation is that we cannot raise large amount of funds. Now there is a very important concept, that is working capital. Before discussing on working capital, let us have a discussion on current assets and current liabilities. What are assets? Assets basically they denote the resources having economic value for the business. Means any resource of the business which have an economic value, they are basically termed as the assets of the business. Now the assets which can be or will be converted into cash within 1 year, they will be termed as current assets. So first we have defined the asset, means any resource of the business which have an economic value, that is asset, and if that asset can be converted into cash within 1 year of the time, it is known as current assets. What are the examples of current asset? That is the cash, the inventory, the account receivables, all these are part of current assets. Again, cash means it can be cash in hand, it can be cash in bank. The inventory, it can be the raw material, the goods in process and the finished goods. So all these things, they are the part of the current assets. Then there are the current liabilities. So liability is something which a company or a person owes. Means if you borrow some money from your friend, then you owe that much of money to your friend. It means that is your liability. So same can be the case with the business. When the business borrows or raises some funds which it needs to repay, then it becomes the liability of that business. So it is simply the Liability is simply something that a company or a person owes to some other person or some other business organization. Now the liabilities which at their inception are intended to pay within a year of out of current assets or earning of the business are current liabilities. See, whatever the business owes is the liability, but if that repayment is due within 1 year, and if that repayment is to be made out of current assets or the current earnings of the business, then it becomes current liability. So we have discussed two important concepts. What is current? One is current assets and one is current liabilities. Now the working capital. Working capital refers to the investment needed for day-to-day business operations. It is simply the investment that one requires for the day-to-day business operations. What is the working capital types? On the basis of concept, the working capital can be of two types. One is gross working capital and one is net working capital. So the gross working capital basically is nothing but simply the current assets of the business. We have already discussed about the current assets. Asset means any business resources which have the economic value for the business, and if these resources they can be converted into cash within 1 year, they become the current assets of the business. And these current assets, they are also known as the gross working capital of the business. Second is net working capital. The net working capital is nothing. It is simply the difference between the current assets and current liabilities. Means we reduce the current liabilities out of current assets, and what we arrives is net working capital. It can be positive. If the current assets are more and current liabilities are less, then the net working capital can be positive, or it can be negative also. If the current liabilities are more than the current assets, then the net working capital will be negative. So the gross working capital, it focuses on the optimization of the investment. It means the investment or the funds available with the business, the amount of funds which are allocated in the current assets, that is basically the gross working capital. High gross working capital implies that higher amount of the funds has been allocated or has been deployed in the current assets. The net working capital, it focuses on the liquidity position of the business. Means what is the liquidity position? Means what is the cash or cash equivalent at hand. The example that we have taken a few minutes back, wherein the 10,000 good was sold for 13,000, effectively there was a profit of 3,000 rupees. But since the payment was to be received after 1 month, there was no liquidity in the business. There was no cash for the day-to-day operations. If the suppliers they came for their payment, the business they does not have the amount or they doesn't have the cash to pay for the suppliers. It means the net working capital position was negative. On the basis of time, the working capital can be further defined as fixed or permanent working capital and variable working capital. The fixed or permanent working capital is the working capital that is required for the day-to-day operations of the business without having any effect of the changes in production. Means even if the production is zero, then this amount of working capital is required for the day-to-day business operations. If the production is of 100 units, again this much of working capital is required for the business operations. Means this is the working capital which has no effect of production, or the scaling up or scaling down of productions has no effect on this working capital. That is basically the fixed or permanent working capital. What can be the examples of fixed or permanent working capital? Like if you are running your office on rent, then the office rent is permanent or fixed working capital. The electricity expenses, the salary, these are all part of the fixed or permanent working capital. Variable working capital, it is the working capital that directly relates with the production. If production goes up, the variable working capital goes up. If the production goes down, the variable working capital goes down. For example, in case of airlines, when the passenger load is high and the flight frequency is high, obviously the fuel cost they rises. The fuel cost is high, means the variable working capital, the day-to-day fuel expenses, they increases because the flight's rotations or the flight frequency is high, because the passenger load is high. So that is the part of variable working capital. But the cost of the flight staff, the pilot's salary, that is basically the part of the permanent working capital, because if no flight is operating, even then the business is supposed to make the salary payment to its staff. So that is the part of permanent working capital. So we have understood what is working capital. We have understood what are various types of working capital on the basis of concept, that is the gross working capital, that is net working capital. Also we have understood the difference between the permanent and fixed working capital. Now what are the factors on which working capital depends? So there are some factors which decides the working capital requirements of a business. The first is nature and size of business. See, the size of business, larger is the size of business, larger is the requirement for the working capital. What is the meaning for nature of business? There are certain businesses wherein the time lag between production and selling is more. So in those type of businesses, the working capital requirement is high, and there are some businesses wherein the time lag between the cash and between raw material and getting the cash after sales, that is less. Then in those kind of business, the working capital requirement is less. Second, demand and supply fluctuations. How fast the demand and the supply they fluctuates, that also decides the working capital requirements of a business. If there is a kind of business wherein the demand remains steady, then the working capital requirement also remains steady. And if there is a business wherein the demand keeps on changing or it fluctuates, for example in case of tourism business, the demand keeps fluctuating. Sometimes there is a huge demand and even the supply falls short, and sometimes there is no demand. So in those situations the working capital requirements are more. Then there is a concept, that is operating cycle. This is when we were talking about the nature of the business. So that basically deals with the operating cycle. Operating cycle is basically from cash, means the owner or the business owners have the cash, they purchase the raw material, then the raw material goes to work in progress, then there are finished goods, then there is a sale of goods, and there is cash. So this is the operating cycle. Longer is this operating cycle, higher will be the working capital requirements. Shorter is this operating cycle, lesser will be the requirement of the working capital. Then next part is credit terms. There are certain businesses which sells on credit. And now what are the credit terms? Because the example that we have taken, wherein the 10,000 good was sold for 13,000, but it was sold on credit, and the credit term was that the seller will make the payment within 1 month. So there was a shortfall in the working capital. So if the business is selling on credit, and then the credit terms or the credit duration will specify the working capital requirements. Longer is the credit duration, higher will be the requirement for working capital. Now delivery terms and delivery policy, that also decides the working capital. Take the case for automobiles. Suppose a company is launching a new model and it decides that it will produce only on the basis of the advance received from the customers. Then some part of the working capital is already covered by the advance received from the customers, so the working capital requirement will be less. To quite contrary, if there is production in advance and then the company is selling, it means the company need to have the working capital for day-to-day operations and production, and then after selling it will get the cash. So the working capital requirement will be higher. So that is basically the production policy. So these are some of the factors that decides the working capital requirements in a business. Then another important aspect, that is the cash or cash management. After working capital, one of the important dimensions of the business is about managing cash. So what is cash? First of all, it is the legal tender, currency or coins that can be used to exchange goods or services. If we define cash in its literal sense, then it is basically the legal tender. It can be in the form of currency or coins, and it can be used to exchange goods or services. That is basically the narrower sense to define cash. In broader sense, it can also include the value of assets that can be easily converted into cash. It includes cash in hand, cash in bank, bills, receivables, etc. So we have defined cash in two ways. One is strictly the literal sense, wherein it is the legal tender or legal currency or legal coins which are used by the persons or used by the citizens of a particular country for exchange of goods or services. In broader business sense, the cash can also include the value of assets that can be easily converted into cash. It includes the cash in hand, the cash in bank, bills, receivables, inventory, etc. So basically, we can say that the current assets, most of the current assets, they qualify for this broader sense definition of the cash. Now, why a business need to hold some cash? What are the motives for holding cash by a business? So first of the motive is transaction motive, means day-to-day business operations. If you are operating a business, if you are running a travel agency, if you are operating a travel agency, there are some day-to-day business transactions. There may be some stationary costs, there may be some miscellaneous expenses, there may be some bills that need to be paid immediately, there may be some payments to the suppliers that need to be made. So all of these are day-to-day business transactions. There may be some refunds also that you need to make to the clients. So these are all day-to-day business transactions. So for making these day-to-day business transactions, we need to have the cash. That is the transaction motive of the cash. Again, in the example that we have taken, the good was sold on 3000 rupees profit, but if the supplier comes for their payment, there was no cash available, means the transaction motive of the business could not be fulfilled. Next is precautionary motive. In business, there are some uncertainties also. So in order to deal with those uncertainties, we need to have some cash. And the best example can be the COVID times, when all the businesses, they were facing the uncertainties. We came across various organizations which could not pay salaries to their employees, as well as there were some reports about some organizations which were paying regular salaries even during the COVID times. So what is the difference? The organizations which are holding cash as precautionary motive, they were able to meet their current liabilities, or they were able to make the salary payments, they were able to make the payments to their suppliers. But the organizations which were not having the cash as the precautionary motive, they were defaulting on the salary payments, they were defaulting on the payments to suppliers, they were defaulting on the loans as well. So when we are operating a business, there are some uncertainties, there are some risks, and in order to cover for those uncertainties and to those risks, to provide a cushion that the business doesn't collapse during those uncertain times, we need to have the cash. That is the precautionary motive for holding cash. Next is speculative motive. Speculative motive means to take the advantage of unexpected opportunities. Sometimes unexpected opportunities also arrives in the business. For example, the demand for a particular product or services rises spontaneously or unexpectedly. You are not expecting the rise in demand, and the demand rises unexpectedly, but you do not have the cash to purchase the raw material. Let us take an example. When there are unexpected opportunities, they arrive in the field of travel and tourism. Suppose there is an unexpected event is happening at Delhi or some metro city, and a lot of people or a lot of tourists, they are coming to visit that event, and you need to make a block in the hotel for the rooms, but you do not have the money to pay advance to the hotel, then you will not be able to utilize this opportunity to the benefit of your business. So this speculative motive basically deals with the taking advantage of unexpected opportunities. So these are three motives for a business to hold the cash. One is the transaction motive for day-to-day business transaction. One is precautionary motive for dealing with the risk and uncertainties in the business. And then the speculative motive to take advantage of unexpected opportunities. So we have discussed about the three motives of holding cash, that is transaction motive, precautionary motive and speculative motive. Now the cash management. Cash management involves determining optimum cash balance, storage and disbursement of cash, and investment of excess cash. So the cash management involves three dimensions. One is determining the optimum cash balance. It again depends on the nature and size of the business. As per the nature and size of business, what should be the optimum cash balance that need to be kept? Because if there is a shortfall in cash, then one of the motives, that is transaction, precautionary or speculative motive, will not be met. If there is excess cash, then it reflects poorly on the financial management, because the excess cash kept in the business will not earn any income. So the cash management deals with deciding or determining the optimum cash balance as per the nature and size of the business. Second, storage and disbursement of cash. See, keeping the cash is also have some its own risks, inherited risk. So how to store the cash, how to disburse the cash, that is also the part of the cash management. And even after deciding the optimum cash balance and there is some excess cash, then what should be done with the excess cash? So how to invest that excess cash so that it earns some income, that is also part of the cash management. So first we need to know what is our optimum cash balance as per the nature and size of our business, and second is how to store and disburse that cash, and even if there is some excess cash, how to invest that excess cash. That these are the aspects that we need to deal in the cash management. Now we will see how to manage cash effectively. How to manage cash effectively, basically again the three dimensions that we have discussed in the cash management. So how to get an optimum mix of all these three dimensions? There are certain aspects. First of all, preferably there should be one account for all cash deposits. Means if there are multiple cash deposits, then rather than having multiple accounts, there should be one account where all the cash deposits related to business can be made. See, if there are multiple accounts for cash deposit, then it will be difficult to know the exact cash position of the business. If there is one single account for the cash deposit, then the business managers or the financial managers can find out the cash position instantly. Second is utilizing float. Now what is float? Let us take another example, that one of your customers, he need to make payment to you, and he said that I have issued the check, and he sent you the copy of the check over email, and he said that the payment is already made. But after issuance of the check, he sent it by courier. The courier takes 3 days, then the check is received at your office, then you submit that check to the bank, and it takes 2 days in clearing. So what is the time lag between issuance of check and its credit to your account? It is around 6 days. So if the check is of huge amount, then that 6 days of interest, that is being utilized by the payer, or that is being utilized by the customer itself. So in case of, if you want to manage your cash effectively, you need to reduce this time when there is a payment, and when you are making the payment, then you need to increase this time, utilizing again we use this float to our own benefit. Means we issue the check and we send it by courier, so that lag or that time period, the amount stays in our account and we get the interest for that. So this float is utilized for managing the cash effectively. In case of payments, the float should be minimum, In case of the payments to the suppliers made by the business, the float should be maximum. Another aspect can be the discount for early payments. We have seen the various offers by the business which says that if you make the immediate cash payment, then there will be the discount. So this is the something that if you, rather than receiving higher sum at a later date, it will be advisable if we can receive the cash, though bit less, but immediately. So there can be the policy of discounts for early payment. Then there should be some mechanism for the constant follow-up of the recovery of dues. Means there should be some specific department, or this responsibility should be assigned to some specific person who need to follow up for the recovery of the dues. Then there should be suitable investment for the excess cash, which we have already talked about in the cash management definition, that if there is some excess cash with the business available, then it should be invested suitably. So in this lecture we have discussed about sources of funds. We have spoken about the sources of funds, that is internal and external. In external sources we have talked about short-term sources and long-term sources. Then we have discussed about the working capital, its types, that is the gross working capital, that is the net working capital, permanent working capital, and fixed working variable working capital. Then we have also spoken about the cash. What are the various motives of cash, that is transaction motive, speculative motive. And then we have also discussed how to manage the cash effectively in a business. Thank you.